If you look at your investment portfolio this morning, which is Tuesday, February the 3rd, you might have felt a bit of a sting. In the last 72 hours, the gold market has experienced its most violent reset in decades. After hitting a staggering all-time high of nearly $5,600 an ounce last Thursday, we have seen a liquidation cascade that wiped trillions off the board. As I'm filming this, the gold is testing the $4,400 level. To put that in perspective, that is a drop of over $1,100 in just 3 trading days. That's roughly a 21% correction. Now, the panic headline is gold is crashing, but the educational question to ask is why? Today, I want to share the mental models I'm using to make sense of this volatility. We'll look at why the nomination of Kevin Warsh was only the first domino, the magical feedback loop, and whether this is the end of the gold bull run or a very painful, very necessary correction. To understand the crash, you first need to understand the rally. For the last year, gold has been on a tear, almost doubling on value. Why? Because investors were making a very specific bet called the debasement trade. The logic was simple. The US government debt was spiraling, the Fed was expected to keep cutting rates aggressively, and central banks, specifically China and India, were buying gold at record rate to de-dollarize. When you combine those, gold became the ultimate insurance policy against paper money. It's like the stretch rubber band. When everyone on one side using borrowed money or in fancier term leverage to buy in, the market becomes incredibly fragile. It just needs a pin to pop the bubble. That pin arrived this past Friday and came in the form of a name, Kevin Warsh. For those of us who aren't embedded in the world of high-level policy, here's why the name matters. President Trump nominated Kevin Warsh to be the next chair of the Federal Reserve, and for the gold market, this was the regime change moment. You might be thinking, can one man's nomination really wipe out $15 trillion in value that quickly? And the answer is probably not on its own. The Kevin Warsh news on Friday was the catalyst, but it hit the market that was already exquisitely sensitive. There are 2 other hidden factors that converged this weekend. First, the CME margin hike. This would be more of a mechanical part of the story. The CME Group, or the Chicago Mercantile Exchange, is essentially a global marketplace where investors trade financial products called derivatives. Assets like gold and silver aren't usually traded by physically moving the bars around, but usually they're traded through derivatives like options and futures. On Sunday last week, the CME Group raised the margin requirements for gold from 6% to 8%, and for silver, a massive jump from 11% to 15%. Essentially, it became 33% more expensive just to hold your position. This forced thousands of investors to sell immediately to meet the margin requirement. Second, the geopolitical ease. Over the weekend, President Trump signaled that he's seriously talking with Tehran, with rumors of meeting in Istanbul this Friday. When the threat of regional wars dips, that fear premium on gold and silver becomes less attractive. This is a part of story that feels like a crisis. Yesterday on Monday and again this morning, we saw forced selling. When the price dropped that first 5%, people who bought gold on margin were forced by the brokers to sell to cover their losses. This creates a feedback loop. The price drops, the brokers force to sell off, that selling caused the price to drop even further, which triggers more forced liquidation. As of today, we're seeing the speculative froth being washed out. It's painful, but in the world of investing, we call this cleaning the slate. Unless you're someone who spends all day tracking the inner workings of the Fed, these market movements can feel completely random. But when we look past the headlines, a different story starts to emerge. As investors, we have to distinguish between price and value. While the price crashed due to the technical perfect storm, which are the CME margin call and that sudden shift in geopolitical tension, the fundamental reason to own gold haven't completely disappeared. The reality of tens of trillions of dollars in national debt and other central banks looking for an alternative to the dollar is still a long-term signal behind the noise. We've spent today looking at the mechanics of why gold just dropped 20%, but the real question is whether this $4,400 level is the generational buy the dip opportunity, or the start of a much longer cooling period. In the meantime, I'm curious about how you're defining the value of assets like gold and silver. Please share that in the comment section down below. And as always, thanks for watching and hope to see you next one.